My name is Andrew Stotson. I want to welcome you to this Valuation Masterclass Bootcamp halftime presentation. In the halftime presentation, our students are presenting their work on their first company that they cover. They're going to write research on 4 companies. This is the first one. The first one takes about 6 weeks because there's a lot to be done in learning how to do research. And then in the final 6 weeks come the remaining 3 reports. The person presenting today is Charlie. He's in Thailand. And I just want to remind you, if you're thinking about joining the Valuation Masterclass Bootcamp, the next one starts in 61 days. And you can use this QR code. And for 7 days, you get a discount that's pretty massive. So you may want to check it out. All right. So now I'm going to bring Charlie in. All right. You ready to go?
Yes.
You've been practicing a lot already, I'm sure.
Yeah.
Okay, so let me pull up the presentation. Now we see the presentation and we see your face and mine, but I'm going to leave because you are the star of the show. So are you ready?
All right. Yeah.
Okay, go.
Okay. So Fastenal is a really great company with amazing fundamentals. So you might be wondering why I think it's a sell. Hi, I'm Charlie. And in this presentation, I'll tell you why I would recommend a sell for Fastenal with a target price of $32, implying a downside of 30%. And I derived this target price from a DCF-based valuation using a WACC of 7.9% and a terminal growth rate of 3%. Now, before we dive further in, let's get to know the company a little bit. So, Fastenal is a US-based industrial distributor firm founded in 1967, and the company's main products are fasteners. And Fastenal operates in 25 countries around the world. However, its main market is in the US. And Fastenal is considered a top-tier player in the industrial distribution market, especially in the US, due to its leadership in smart inventory management, strong network, and also high financial quality. Now, let's get into why I think it's a sell and why I think it's overvalued. So, first of all, the double-digit revenue growth is not sustainable. The US manufacturing just exited a 26-month contraction in January of 2026, and this drives a 12% year-over-year daily sales growth for Fastenal and supporting 10% revenue growth forecast for 2026. However, this level of growth is unlikely to persist. Historically, revenue growth stripped of COVID outliers is closer to 8%. Additionally, a key growth driver is showing signs of deceleration. Management revised down their 2025 FMI signing target, and the full year 2025 signings of 25,000 is below 24 of 27,000. Still, due to the positive manufacturing conditions, I believe the 2026 signing target of 28,000 to 30,000 is achievable. But once the manufacturing expansion settles, I forecast that signing will decline and revenue growth will converge towards 7% by 2030. Now, secondly, profitability is limited by the gross margin pressure. So gross margin contracted from 45.7% in 2023 to 45% in 2025. And this is driven by the mix shift as FMI customers demand a broader range of non-fastener products, which carry lower margins than fasteners. However, the FMI and strategic focus on large accounts also allow for improved SG&A and a significant reduction in physical branches, making the decline in net margin only 0.4 percentage point. Still, with limited visibility on the magnitude of future SG&A gains and largely exhausted branch rationalization runway, I expect only a slight net margin improvement to around 15.7%. Now, lastly, the market is expecting an unsustainable premium. At 38 times forward P/E, the market is implicitly assuming that double-digit revenue growth is sustainable in the long run. The ROIC of around 35% remain elevated versus an industry average of just 16%. And margins are expected to rise despite the ongoing mix pressure. Now, each assumption is questionable on its own, but together they are quite unlikely, especially with the FMI signing slowing down and the margin pressure from product mix shift that is expected to persist. Now, the current market price, I think, reflects an overly optimistic scenario for Fastenal that I do not agree with, given my medium-term forecast. Now, let's move on to the industry analysis just a little bit. So In the industrial distribution industry, there are no monopoly. The main key players are Fastenal, WW and Ferguson Enterprises. And the market is growing at 5% annually, so around 3 trillion in 2025 to around 4 trillion by 2030. And the manufacturing account for largest part of the revenue in main players like Fastenal and WW Granger. And sales are growing faster in e-commerce compared to traditional way. Now, let's see the past year performance. From the fourth quarter of 2024 to the fourth quarter of 2025, we see an 11% year-over-year growth, but the gross margin declined by 0.5 percentage point. However, the operating margin increased a little bit. Now, one important news that I want to focus on is that Fastenal just began the construction of a new Southeast US logistics center in Georgia, and this represents a major capacity investment. Now, before we go further, let's take a look at the consensus estimate. So the mean target price is $44.6, which indicates a 2.4% downside. And the consensus forecasts around 10% year-over-year growth in revenue in 2026, followed by 7% by 2028. Now, let's take a look at the revenue breakdown for Fastenal. So like I said, most of the revenue comes from the US at 83%, and its main customers are manufacturing companies, accounting for 76% of customers. Now, contract customers, which include large enterprises and government, accounted for 75% of Fastenal revenue. And fasteners have always been Fastenal's most profitable product and the main product as well. And they represent 31% of revenue. However, fastener share has been declining as on-site customers generally purchase a broader range of products. And this product mix shift and the concentration of sales to contract customers have compressed gross margin for Fastenal. Now, let's take a look when we compare Fastenal to other companies in the US. So the FBMR framework introduced the fundamentals, valuation, momentum, and risk. And Fastenal performed really well in terms of fundamentals and risk. But in terms of valuation and momentum, they are quite average. Now, when benchmarking against other industrial companies worldwide, Fastenal is ranked among the best because of its high profitability from their really good asset efficiency and expense control. However, their revenue growth and expense direction is average. Now, let's go into the forecast of the financial statements. So I forecast that revenue growth will go to around 12 billion by 2030, and this is around 10% in 2026 and 2027 and 2028, which will go down to 7% by 2030. And I forecast that net profit will grow to around 2 billion. Now for the asset, I forecast that cash will go down to finance the new projects, and in the end total asset will go to around 7 billion. For the liabilities, I expect that the liability will go to 1.5 billion and the total equity to go to around 5.6 billion. For the cash flow statement, the thing that we need to focus on is the capital expenditure, which I forecast that it will go up because they are investing in new distribution center and also like new equipment. Now, like I said, the profit margin, I expect it to be lower because of the FMI like product mix shift, but EBIT margin will improve a little bit. And like I said, revenue will go to around 1099, supported by the good manufacturing industry right now. For the free cash flow data, I expect a NOPAT in 2030 of around 2 billion. And the free cash flow to firm is around 1.9 billion. Okay, now let's take a look at the relative valuation. On the forward PB multiple, Fast trades at 12.4 times, which is significantly above the US sector average of 7 times and the global average of 4 times. However, this premium is partially justified by Fast superior ROE of 34%, which is really high. But on a PB to ROE basis, Fast trades at 0.36 times compared to the US sector of 0.26 and the world at 0.23, suggesting the market is pricing in a quality premium above what the ROE alone justifies. And this indicates that Fast is very expensive on a relative basis, even after accounting for its superior profitability. Now, on the forward PE multiple, Fast trades at 38 times, a substantial premium. But despite this premium, Fast 2026 EPS growth of 11% is actually below the US sector average of 21%. And this confirms that Fast is expensive on a PE basis, and the market is pricing in a quality premium well beyond what the near-term earning growth justifies. Now, for my DCF, I assume a risk rate of 2.5% and a market equity risk premium of 6.5%. Now, Fast has historically been a low beta stock, so I assume a beta of 0.9. And I forecast a capital structure with around 8% debt, and this results in a WACC of 8%. And the terminal growth of 3% is used, which reflects the strength of Fastenal in the industry, leading to a value of $32 per share based on the FCFF methodology, and this represents a 30% downside. Moreover, in my sensitivity analysis, only in the most optimistic case where terminal growth is 5%, which is highly unlikely, will it result in an upside, as you can see here. Now, before we wrap up, let's take a look at some of the risks. So the main risk comes from geopolitics and increasing competition. So first of all, the exposure to tariffs and import cost volatility can affect their margin, and the supply chain disruption and global sourcing risk can also affect their margin. Now, the increasing competition from large distributor and e-commerce players will affect both their margin and their revenue. And this will further run my narrative of the price going down. So in the end, I want to say that Fastenal is a really, really good company, a quality compounder, but it's priced for perfection. That's it for me. I'm happy to take questions.
Great. And we got a lot of questions. Let's start. Moment asks, why is your terminal growth rate only 3% when you forecast the industry to grow at 5% through 2030?
Because in the long run, I don't think that the growth rate of 3% is possible, because there is a limit, and when we forecast to infinity, it cannot grow faster than the GDP. And I think the 3% makes the most sense.
Okay. And also, Moment said, with only 3 to 4% market share in a fragmented industry, why can't Fastenal maintain higher growth by taking share from smaller peers?
Okay. That's a really good question. So I think that for Fastenal, they mainly target the big players, and for other players, they target other group. And Fastenal do not really target the smaller group. So I think it's going to be hard for Fastenal to get their signing with the smaller group. And I think that the big player in the manufacturing is already signed with them. So I think it's hard for them to gain a lot of market share.
And one place where you could be wrong is if they could come up with a plan to expand globally in a big way. Okay. There's a huge market. If they could expand just in Thailand, as an example, there's plenty of factories that would use their service. And
yeah, I agree.
Europe and every other place. What is your impression of whether management's going to do something like that, or what is your thought about the probability of that happening? And not just setting up, but I mean really moving towards 30% or so of their revenue coming from outside of America.
Okay, so I think it's likely that in some day that will happen. But in the near term, it's really hard to say. But I think that's a reason why they do not already move a lot into the other place in the world. So yeah, I think there are competition that is really high in other places of the world as well, and their products they get from China, right? So there are already the market for that in other places as well.
Okay, let's keep going. Roman says, what steps would Fastenal need to take to revive its market position and return to double-digit growth?
Okay. So I don't think this is like for valuation, but we can talk about it. Let me think. Yeah, I think they just need to like be more aggressive in their like getting sales, getting their signings up. Yeah. And they need to take advantage of the US manufacturing rebound.
All right, let's look at the next question. Moment again. You note Fast's 11% EPS growth is below the sector average of 21. Is this a permanent trend or a temporary result of the current manufacturing cycle?
I'm not sure like if you're talking about like the sector average of 21% or the fast.
Let's say the sector average of 21%, first of all.
Okay, so I don't think it's permanent because this sector is really like cyclical. When the economy is good, this one is good. So when it's bad, it's bad. So the EPS growth is gonna be bad when the economy is bad. And fast,
Okay.
I think it's the same, but it's a little less volatile because it's really low beta.
Okay. And another one from Himani, what does Fastenal do better than competitors? It's actually hard to replicate. People have talked about others coming in and, copying their model.
Yeah, so Fastenal has like I said, they are the leader in terms of like managed inventory. The FMI model that they have is really good. The customers like really value it because they have constant access to materials. And I think this model is really good, but it can also be like affected by the e-commerce, like from other places that can sell for cheaper. The manufacturer might go for them instead.
Okay. Next question is, why do you forecast signings and revenue growth to decline to 7% given that U.S. manufacturing PMI has recently improved? I mean, shouldn't we be upgrading and having great numbers going forward?
Yeah, so I don't think that the growth is gonna be like around 10% for forever, because the economy, the manufacturing sector is really good now, but we would really be good in the like say next 3 or 4 years. And I think that one of the reasons that the manufacturing is really good right now is because post-COVID, like people have a low inventory, and past that, and during this time they have to like restock. So it really go up right now, but we don't know for sure if it will continue.
All right, here's another one. If ROE is still significantly above peers, why shouldn't the company continue trading at a premium? It is creating a lot of value.
Okay, so I don't think ROE like is like a good way to look at this. Like for example, from how I look at the dividend, and I don't think that the dividend will grow as much as to like give them like the really good long-term value which the ROE reflects.
Okay, and Surya says, what would need to change in the next couple of quarters for you to revisit your sell recommendation? So, for instance, the share price falls, or they announce some, surprise, or what would you be looking for?
Okay. So the easy answer is that if the price go down to around what I forecast, I think that would be when I would recommend a buy.
In other words, it's really a price story for you.
No, not just that. I'm just saying that that's the easy answer.
Okay. Yep.
But I think if they could really gain a lot of market share through their FMI, I think I would consider the high premium for Fastenal.
Mm-hmm. All right. This is the last question. Why is Fastenal so focused on the U.S. market, as it has many suppliers in Asia and potentially could expand to other regions fast?
Okay, so in the global industry distributor industry, Fastenal is not even like one of the big it's big, but like it's not being compared to the big player. Like I can't remember the name, but the one in the Europe is really big, and they have like they have customers everywhere in Europe, and also other places as well. Like in China, for example, if Fastener gain their products from China, China can also put their products into their own country as well. So it's really hard to gain market share in other place, I think.
All right. So how does it feel to complete this assignment?
Well, I think it's really challenging, and I want to say that you and like the team have really helped me a lot, especially like Moment. I can always consult with him. And yeah, I feel great for having completed this. I feel like I learned a lot, and it's really valuable.
And if you go back 6 weeks ago and you look at what, where you were at when you joined versus where you are now, what would you say is the main thing that you gained?
I think I gained a lot of financial knowledge, and especially in terms of like how to look at the company and see like what's the rationale for it, the price to go up, to go down, what would drive the revenue. I learn a lot of things, and especially when looking at the financial statement, like I would never do that before. And in this course, like I look at them like for a couple of hours.
Yes, we look at financial statements all the time. I'm just looking at some today. Fantastic. Well, congratulations. And that was well done. And I think I'll see you in the Slack channel, and then I'll see you on Friday night.
Okay.
All right. Another great presentation. Charlie just gave his presentation. Remember, the next boot camp starts in 61 days. I hope to see you in there. You can see Charlie's really building a competitive advantage in company valuation. And just wait until he's completed 3 other company valuations, the amount of knowledge and confidence that he will build. So I hope to see you in the next Valuation Masterclass Bootcamp. And I hope that you build a competitive advantage in company valuation. My name's Andrew Stotz.